A private equity fund sells an investment for $12 million. Then it distributes $10 million to the LP. So what was the profit? 12 million, 10 million, 4 million, or just 1 million? All four numbers appear in the same story, but they do not mean the same thing. By the end of this video, you'll know exactly what was earned, what was distributed, what moved through P&L, what changed NAV, and what should appear in the books. Let's build the full picture. The fund originally invested $8 million. The entry was simple: debit investment 8 million, credit bank 8 million. At the next reporting date, the investment was valued at 11 million. That created 3 million of unrealized appreciation. Debit investment 3 million, credit change in unrealized gain 3 million. So before the exit, the carrying value was 11 million. Now the investment is sold for 12 million. Cash received is 12 million, but the carrying value removed from the books is 11 million. So the immediate exit entry is debit bank 12 million, credit investment 11 million, credit realized gain 1 million. Here's where many candidates stop, and that answer is incomplete. Why? Because 3 million of gain was already recognized earlier as unrealized appreciation. That amount must now be reversed or reclassified. Debit change in unrealized gain 3 million, credit realized gain 3 million. Now the total realized gain over the life of the investment is 4 million. 8 million cost, 12 million proceeds, 4 million total gain. But the current period increase is only 1 million. Why only 1? Because the other 3 million had already increased NAV in an earlier period. That distinction matters. Exit proceeds are 12 million. Total realized gain is 4 million. Current period NAV increase is 1 million. And cash distributed to the LP is 10 million. Four different numbers, four different meanings. Now let's follow the 10 million distribution. Assume the fund retains 2 million for expenses, reserves, or future obligations. So 12 million came in, 10 million goes out. 2 million stays in the fund. The distribution entry may be debit partner distributions 10 million, credit bank 10 million, or if declared before payment, debit partner distributions, credit distribution payable. Then, when cash is paid, debit distribution payable, credit bank. Account names may vary by structure and policy, but the economics do not. Distribution is a cash event, profit is a performance event. They may happen on the same day. That still does not make them the same thing. Now look at NAV. Before the exit, the investment was carried at 11 million. The sale brings in 12 million. That creates a 1 million current period gain. So NAV rises from 11 million to 12 million. Then the fund distributes 10 million. Cash falls by 10 million. Partner capital falls by 10 million. Total fund NAV falls by 10 million. But P&L does not fall because of the distribution itself. So the ending NAV is 2 million. Opening carrying value 11 million plus current period gain 1 million. Less distribution 10 million. Ending NAV 2 million. This is the line to remember. The exit gain affects performance. The distribution moves capital. And one more trap. A realized gain by itself does not increase DPI. A qualifying cash distribution may increase DPI. If paid in capital was 8 million and the LP received 10 million, DPI may be 1.25 times, subject to the fund's reporting policy and treatment of recallable amounts. Now the numbers are clear, but the real operational questions begin after the calculation. Who approves the distribution? What notice goes to investors? Which books and schedules move? What happens if part of the cash is recallable? And how does a junior answer differ from a senior answer? The calculation is finished, but the distribution cycle is not. First ask, why is the fund distributing cash? The source could be an exit, dividend, interest, refinancing proceeds, returned escrow, or excess cash. Then determine what is available. Start with cash. Deduct taxes, fees, debt repayment, escrow, reserves, and amounts the fund must retain. In our example, 12 million came in. 2 million stays in the fund. 10 million is proposed for distribution. Next comes classification. Is it return of capital, income, realized gain, a recallable distribution, a tax distribution, or recycled proceeds? The cash amount can be the same, the reporting meaning can be completely different. Then run the LPA and waterfall. Who is entitled to the cash? Does the LP receive everything? Does the GP receive carry? Is any amount held back for clawback protection? Never assume the bank balance decides the allocation. The LPA does. After that comes review and approval. Confirm cash availability, the waterfall, partner allocations, tax, and withholding. Then issue the distribution notice. It may show allocation, classification, recallability, withholding, and payment date. Now update the books. The general ledger records the exit, gain, payable, and payment. The investment ledger records the disposal. The realized and unrealized schedule explains the 4 million gain and 3 million reclassification. The waterfall model shows who gets what. Partner capital accounts separate profit allocation from cash distribution. The distribution register tracks amount, date, classification, and payment status. The LP statement separates performance from capital activity. The DPI schedule captures qualifying distributions. Recallable amounts and carry are tracked separately. The cash may move once. The accounting trail touches nearly every investor reporting record. Now you are the junior fund accountant. Your test is execution. Did the 12 million arrive? Was the investment removed at the correct carrying value? Was prior unrealized gain reversed or reclassified? Does 10 million equal the approved distribution? Where the entry is posted? Do the register, bank, capital accounts, LP statement, and general ledger agree? A strong junior does not just process cash. A strong junior reconciles the full chain. Now you are the senior reviewer. Your test is judgment. Was enough cash retained? Is the distribution recallable? Can proceeds be recycled? Was the correct waterfall applied? Is GP carry subject to clawback? Does DPI treatment match policy? Are tax and withholding correct? Does the classification agree with the LPA? Can you find the risk even when the spreadsheet adds up? Now a few nuances. A partial exit requires correct allocation of cost, prior unrealized gain, realized gain, and remaining value. Escrow may exist but may not yet be distributable. Recallable cash can leave today and still increase future funding obligations. Recycling may keep proceeds inside the investment cycle. An in-kind distribution moves securities, not cash. Withholding can make gross entitlement differ from net payment. A period end declaration may create a payable now and cash movement later. And carry may be allocated before the GP receives cash. Before sign off, run the controls. Exit proceeds per bank must agree with the books. Opening capital plus contributions and profit allocations less distributions must equal ending capital. The bank must agree with the distribution register. Partner capital must agree with the general ledger. The LP statement must agree with the capital roll forward. The DPI schedule must agree with qualifying distributions. Recallable amounts must agree with the unfunded commitment treatment. And the carry schedule must agree with the approved waterfall. Here is the interview answer. First, identify what created the cash. Second, calculate the profit. Third, determine what is available for distribution. Fourth, apply the LPA and waterfall. Fifth, post the entries and update the books. Sixth, check NAV, DPI, capital accounts, and investor reporting. That is the distribution Bible. Remember the traps. Exit proceeds are not realized gain. Realized gain is not current period gain. Distribution is not profit. Distribution reduces NAV, but it is not an expense. Cash paid is not always permanently non-recallable. And a completed bank payment does not mean the cycle is complete. Trace the source. Separate performance from capital. Then follow the cash into the books. Subscribe to the Fund Desk for private markets accounting through real numbers and interview scenarios. And share this video with someone who works in fund accounting or is preparing for an interview.